Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. And on today's show, we welcome back David Keller, who's the president of Sierra Alpha Research. How are you today, David?
I'm well, Karem. Good to be back. Good to see you.
Let's begin by talking about gold and the price action for this year. Back in August, in our previous interview, we talked about the breakout from the 1360 level. So from a technical perspective today, what does gold need to do to look more healthy and perhaps turn more bullish as we go into 2020? What are your thoughts on gold at the moment, David?
Yeah, absolutely. I mean, when we talked over the summer, you had this situation with gold, sort of emerging out of the 1300s into the 1400s. You had this, progression of higher highs and higher lows. And I remember in particular seeing the divergence with momentum. So RSI is one of the main tools that I use just to measure the relative progress of price action over time. And so you had the situation of higher highs in gold, but lower peaks in the RSI, which is a little concerning. But what we never got was any sort of breakdown, any sort of confirmation of that signal and a break, below the swing low. Every time, the gold made a higher high in sort of the month of July, it established a higher low as well. And then finally broke out at the beginning of August to continue on into the 1500s. What happened again, though, you had a similar pattern in August where you had higher highs in the price, lower peaks in the RSI, and in this case, you actually did get follow through to the downside. So the beginning of September, you actually broke down through the low from August, which sort of validates that divergence, sort of tells you, yep, a top of some meaning is in place, and you want to be more cautious. And since then, as you alluded to, we've had this sort of stepwise motion to the downside. So, where are we at now? I would say a couple of things. Overall, I would say same thing that we talked about over, in the summer, that the long-term picture of gold, I think from a technical perspective, still looks very constructive. And again, you see gold as a multi-year base, sort of this rounding, bottoming pattern that has emerged. And even though the last couple of months have been relatively weak, especially relative to other assets, overall, if you look at a weekly chart of gold, it's still making a higher high. And you could argue that the low that we've seen in the last couple of weeks here in November, December, arguably a higher low from what we saw back in May and then again in July. So overall, from a long-term perspective, I think the trend is still progressing. The challenges in the short term and how you manage that. So I would say that the fact that gold has pulled back so much, coming down from 1565 or so, down to the low 1400s is a pretty significant pullback. It pulls us back to that congestion range in the low 1400s that we saw back in July when we spoke last. I think that's one reason why, anytime price pulls back to a congestion area, an area at which there's been a lot of activity, a lot of people would expect that tends to be an interesting place for new buyers to come in. The other thing I would say, going back to RSI as a measure of momentum, if you look back in the April-May timeframe of this year, gold had a run up to 1340, 1350, had pulled back a pretty good amount, over a third of the way back down, and retraced that rally, and the RSI got down right to about 40. And it never got much lower. And what happens with RSI as a measure of momentum in a bull phase, overall, if the market is constructive, the RSI rarely gets below 40. 40 is sort of that pullback range where you'd expect, a next leg higher. And then when the market rallies, it goes well above 70. And that's what we saw in June and again in August. So what's happening right now is I think you've had a pullback that looks really similar to the first half of 2019, where you had a nice pullback off of the highs. In the short term, lower highs, lower lows, the RSI gets to about 40, and then that ends up being another leg higher. So overall, I think it's setting up in a very similar fashion. So overall, I think short term, it's actually potentially an interesting time to accumulate on weakness.
Excellent. Well, let's talk a little bit about narrative within the markets, and how important is narrative when trading or investing within a sector, David? We could argue that there is always undiscovered value in a sector or a stock somewhere in the markets, but if the narrative or a new catalyst hasn't fallen into place, then perhaps the value could potentially stay undiscovered forever. What are your thoughts on this?
It's a really, really interesting question. And the way you phrase the question is actually really interesting, because when you talk about a narrative, I think there can be positive connotations to that, but also potentially more negative connotations to that. Where narratives are good is when it causes you to think through some potential outcomes. And I love the idea of planning, having a good plan for what could happen. So with gold that we talked about, it could continue lower. It could drift lower going into the new year. It could reverse just as I would sort of expect and go higher. But either way, I better have that in my head in terms of where I would potentially see it going, what my plan would be, how I would trade around that. So then if something different happens, I have some guideposts. I have some guidelines that I want to be able to follow. And a lot of times we're caught without any real good expectation of what could happen next. And then we're just caught off guard by anything. And that's not going to work. Where narratives are bad is when it causes you to ignore the evidence, ignore the data because you're so tied into your narrative, right? I think the stocks are going to be strong into the new year. And I'm not saying this is what I think, but this is a potential narrative. I think stocks are going to be strong. I think a U.S.-China trade deal is going to happen tomorrow. I think gold, as a result, is going to be super weak. I think bonds are going to sell off. And you have this whole narrative. And then you basically are completely mentally wed to that narrative. And when things happen differently, you start to get very defensive and you defend your narrative as opposed to just reacting to what you see on the charts or from the price action, from the markets themselves. So I would say that, especially now where you have a lot of emerging catalysts and there have been so many of them, and not just macro drivers, but even at the sector and industry levels, especially in technology. In the US, you have a lot of emerging technology, emerging business plans, things that are, companies that are structured very differently. And as a result, you better have a narrative for how you think that could play out, because it helps you, sort of project a future outcome and determine how you would react to that. But I would say anytime you do lay out a narrative, it's always good to imagine some alternative scenarios. So, one of the exercises I've done with professional analysts, professional strategists is, all right, we would have the bull bear debate. If we all caught ourselves being bullish on a sector or on an asset, one of us had to be, just argue the alternate point and argue it vehemently. And it caused you to just break out of your narrative a little bit and see some alternative outcomes. And then we would have sort of our base case, and then we would have some potential alternatives and some good ways to deal with that. So, narratives are very, very helpful, but always focus on the evidence, see how things are evolving, and that helps you understand how the market relates to your narrative.
Let's talk a little bit about chart reading. Does your intuition at reading a chart get better with age, David? And throughout your career, have you had to simplify what you're actually looking for? Talk to us about perhaps how you traded when you first started out when compared to today. Are there any major differences?
Karim, hopefully like a fine wine, technical analysts sort of improve with age, let's hope, right? I mean, that's fingers crossed, that's where we're all headed. It's an interesting question. I would say that absolutely. I would say in some ways my approach has simplified a great deal. I think when you're learning the technical toolkit, especially, and for me, it was going through the CMT program where you have to learn all the different parts of the toolkit. And what happens is you have to learn them. You have to be able to articulate them, apply them in real life situations. But in the end, if you use everything that you've studied, it's overkill. It's way too much. And as a result, you'll get way too many signals to actually be usable. So what I find is right at the beginning, sort of going through that process, you just had way too many tools that you were using. Eventually, you have to refine it down to what your approach is. And I certainly have found over time that there are things that I naturally gravitated to. For me, price and the relationship of price to some measure of momentum for me is sort of the basic way that I think about a chart. So I'm looking at price and moving averages and RSI. And if I had nothing else, those three things I think would give me a pretty good read on where things are headed. But there have been times earlier in my career where I would have made it way more complicated and incorporated a number of other techniques and tried to look for confirmation and non-confirmation. And all of a sudden you make it very, very busy. What's interesting is that my former role at money management firm here in the US, we actually did some academic study looking at seasoned technical analysts versus novice technical analysts and how they actually interacted with real charts. And what we found was as people went up in experience, the amount of time it took for them to make a decision was much, much smaller. So they were able to much more quickly come up with a buy-sell decision or a bullish-bearish decision based on the evidence. That's not super surprising, right? Because if you do anything for a longer amount of time, you tend to get quicker at it, more efficient at it. That's fine. But what I think what was really interesting when we actually looked at eye trackers, we could actually see where people were looking at the charts. The novices were actually looking all over the charts. They were looking, all over the screen, looking at the current price, but all through the price history. They were looking at everything on the page. And then they would, over a longer period of time, make their decision. The seasoned analyst, the most experienced analyst, did it super quick, and they just focused on a couple key inputs. They looked at the current price. They looked at the, whatever indicators at the bottom, like relative strength or RSI or something like that, and maybe a couple other quick things, and that was it. It was really focused on it. And what we sort of learned from that, and then doing a lot of interviews afterwards, sort of talk about it. It's almost like your peripheral vision. You focus on the really important stuff. You sort of gather some of the other content intuitively, but you really don't have to analyze some of the inputs as deeply because you're just focusing on what you found to be most helpful. And I think that's what I found over time. So every weekend I go through the entire S&P 500 chart by chart. And years ago, that took me a couple hours. And now it takes me about 20 to 30 minutes because I'm just focusing on certain things and I'm doing it regularly enough that I'm not having to re-consume all of the data every time. I'm just kind of mentally adding the last couple bars and remembering how it relates to the price history. So yeah, I would say over time it's become more simple and arguably, hopefully more efficient and boy, more accurate. That would be good too.
Okay, as we're heading towards the end of 2019, has there been anything that surprised you or caught you off guard during this year? And are there any markets that have surprised you in this way?
It's such a good question. And I would say, there's plenty. I think one of the things that's so exciting and so fascinating about what we do analyzing the financial markets is there's always something that's surprising. There's always something that's kind of, that's different or that's unique or that, makes you have to scratch your head and rethink a little bit. So I think that's one of the reasons why the fact that the markets are dynamic and that they're fluid, I think is what makes this so interesting for many, many years. For 2019, thinking about the year, I would say just the relative performance, the strength in defensive parts of the U.S. equity market in a bull market phase, I think caught a lot of people off guard, and myself included. There are a lot of ways to think about that. So, the market rallying through much of the year and utilities and real estate at times being at the top of the list, doesn't make a ton of sense. It didn't surprise me in that I've seen that before. So back in, I want to say like 2014, if I remember right, pretty solid bull market in the U.S. and the strongest sector was utilities. So, if you just looked at the market and then bought sectors that you thought should outperform because the market was doing well, you wouldn't have done as well as if you just looked at the price and recognized that utilities were on a relative basis the best place to be. So it didn't surprise me in that the fact that I've seen something like that before, but it certainly surprised me in that in a period of market strength, defensive parts of the equity market performed so well. And when you think about it, there are a lot of reasons for that, but I would say in general, investors in a search for yield and a search for income, utilities, real estate, those are things that pay a pretty decent dividend. But the fact that the capital appreciation was pretty solid as well overall, it ended up being a really compelling trade. And maybe on the alternate side of that, within consumer, if the consumer space in the U.S. You have consumer discretionary and then consumer staples. So consumer discretionary, traditionally offense, things like retail, luxury items, consumer staples, more defensive stuff, tobacco, alcohol, those sorts of things, and over time in a bull market phase, you would expect consumer discretionary in general to outperform consumer staples. If the market's doing well, it makes sense. People are more speculative buying, leaning more toward offense. And that's completely not happened. That ratio of consumer discretionary to staples has been trending downwards consistently for most of the year. After the beginning of the year, that rally out of the Christmas Eve low of last year, that ratio has kind of been going lower. Amazon, not doing so well on a relative basis certainly has hurt that. But even on an equal weighted basis, the ratio is still relatively muted. So I would, for me, it's been a great reminder to not think too much about, okay, I think the market's doing X. I think the market's felt pretty strong and that's good. But you can't just place equity bets based on what you think should do well based on a certain macro condition. You really want to look at the prices, look at the assets themselves and see what's actually doing well. Because a lot of times, like we saw this year, something like defensive parts of the market do well and you wouldn't expect that normally.
Okay, as we begin to wrap up, is there anything that you've read this year that has helped you as an investor or a speculator within the markets? And is there anything else on your mind at the moment you'd like to share with us?
I love that question, Graham. It's so good. And I appreciate it. two that I would say that come to mind. One is Rework, and it's by a couple gentlemen whose names I'm going to blank, but they found this company called 37 Signals, and it's essentially a technology startup. And having relocated recently from the Midwest of the U.S. out to the West Coast, I'm up in the Seattle area now. Very much it's the tech startup mentality, the West Coast mentality. So you have Microsoft and a lot of former Microsoft engineers that have left and started their own things, and we're closer to Silicon Valley. And so this whole, part of the financial industry is an area I've been less familiar with. And this book, I would say, helped a great deal just to sort of get inside the head of someone starting a tech startup and what it means and why you remain small and how you deal with outside funding, just the whole venture capital, private equity sort of environment and what that means, how that fits into your approach. They actually argue against having a business plan at all because they say it sort of locks you into some narrative that you may not want your company to evolve in. So I don't necessarily agree with every, conclusion they made, but it was fantastic for understanding, what's become a large and very growing part of the equity landscape, is just the impact of venture capital and just the technology sector, how you value some of these companies. So I thought that was really, really good. The second one is a book by Michelle Schneider called Plant Your Money Tree. And I interviewed her just recently at the Las Vegas Traders Expo. And her book I thought was very simplistic, but beautiful in that way. It's a book talking about just different phases in the equity markets or in other markets, how to think about them. And it was more of a technically oriented book, thinking about moving averages and how to bucket stocks and sectors and ETFs based on where they're at in their different phases, but why those phases are important and how you should invest in different phases. So especially with gold, as it's been in a long-term uptrend, but has pulled back recently, it's a really, if you look at that book, you'll see how she sort of describes behaviorally how you should think about that and how you should approach it. So those were two that certainly come to mind.
Fantastic. Okay, well, many thanks again for your time today, David, and it'll be great to have you back on the show again in a few months' time.
Sounds good. Have a great holiday, Krem. Thank you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?